Hi everybody, welcome. Please allow me, give me a few more moments to fix up my setup and we will be on our way. Okay, give me a few moments, please. I've enabled everything. Guys, please, can you let me know whether you can hear me loud and clear, whether you can see the slide of the presentation, and whether you can see me or not. That's not that important, but still, please give me a thumbs up to make sure that I can actually communicate. I've actually enabled communication via the chat. Please let me know. Okay, I see people joining. Welcome, guys. I see Mario, Andrei, excuse me, Joshua. Okay, Tina. Hi, everybody. See Tuan. Sorry if I'm butchering your name, man. Apologies. I see Shaw. Welcome. Okay, so it's a lovely flow. Okay, welcome, guys. Welcome. So today let's just begin. So today we're gonna be continuing on from our 2-week off period. So we're gonna continue on to our, in a sense, series. Okay, and we will venture into technical analysis once again. So we're going to go over technical indicators. More specifically, we're going to look at Fibonacci retracement. There's not enough time to go over everything in regards to Fibonacci. We have a lot, extension, expansions, and all those lovely other stuff. We're going to cover them on the next webinar. And we're also going to cover MACD. So two of the most widely used technical indicators that traders use. Okay, some like them a lot, some don't. Fair enough. What we aim to do here is to, in a sense, a brief introduction. How are they compiling information? What kind of information are they giving us? How to interpret them? And at the end of the day, eventually, in a sense, learn how to use them properly, in a sense, to time our entries, exits, and judge, in a sense, where the market is headed towards to, and how we, in a sense, can capitalize upon this and make gains. Okay, so again, Fibonacci retracement and MACD are the topics of the day, and they are big topics. Hopefully, we're going to cover them as soon as possible. Fear not, we will do individual webinars on each and every one of these. Just remember, today is going to be a brief intro, okay, because there is a lot in regards to the aspects of these technical indicators. So, okay, I think it's time to begin. This is a quick warning and a disclaimer. Thanks for the thumbs up, everybody. You can hear me loud and clear. Thank you for the comments as well. Let's get started. Risk warning and a disclaimer. You can read these at your own time. At the end of the day, we're not providing any sort of investment advice here. This is for educational purposes only. This is the underlying kind of theme of this slide, this risk warning. So the agenda for the day is going to do a brief intro into what technical analysis is and technical indicators in general. Okay, we're going to do a recap. It's nice, at least from your feedback, it's nice to hear them time and time again in order to, let's just say, consolidate this kind of information. We're also going to cover the topics of Fibonacci retracement and moving average, convergence, and divergence, what we call MACD. Okay, at the end of the day, what we care about is how to interpret it. So, moving on. Making a start with an intro to technical indicators. So remember, in the past, I've managed to classify these into two more categories. We have mechanical analysis and charting analysis. Charting analysis, in a sense, you plot stuff on your graph in order to validate where the trend is moving towards to, where the price action may stall or where it has stalled in the past, where it has rebounded from the past. Okay, support resistance levels, drawing trend lines, and all those other stuff we've covered in the past go underneath this kind of category, what we call charting analysis. Again, this is my point of view. This is my way of putting out this kind of information. Okay, you may find this information distributed differently. At the end of the day, these are the same stuff. Okay, so today we're going to focus primarily on mechanical analysis because we're talking about technical indicators. And under this kind of category, we have moving averages, oscillators, envelopes and bands, and many other technical indicators. Again, we're going to focus Fibonacci retracement and MACD. So mechanical analysis is in a sense performed by the use of moving averages primarily. Super simple to apply to your charts and easy to understand what kind of information they convey. That's why they are popular. There's a good reason why most traders use them. Okay, so they serve as a visual illustration of where the market is heading towards to. Plain and simple, that's it. Okay, so mechanical analysis is performed by the use of moving averages, oscillators, envelopes, and bands, and other technical indicators. And the aim, excuse me, of the technician is to establish the market sentiment by the help of all these prevention tools, and there's plenty. So technical analysts or chartists, that's what people call them these days, look for technical indicators in historical asset price data to judge, in a sense, entry and exit points. That's what we do in technical analysis. We look at past price action and we infer and we project and we extrapolate possibly where the market is going to head towards to next, in a sense, to capitalize upon this quote-unquote predictability of the market, because it moves in certain kind of predictable trends and ways. Okay, that is what we, in a sense, are attempting to do with technical analysis. So there are several technical indicators that fall broadly into two main categories. We have overlays and oscillators. Okay, overlays go on top of the chart. Fibonacci retracement is going to be classified as an overlay, goes on top of price action, whereas most oscillators go below the chart, not on top of price action. They have a separate kind of window below your price, below the price action, and they give you specific information, whether that's going to be sentiment, it's going to be strength of the market trend, or a pivot of market trend, depending on the indicator you have. Okay, so overlays and oscillators. Okay, we're going to dive into deeper into all of these in as we progress throughout the series. Okay, so technical indicators are known as technicals plainly, and are focused on trading data such as price, volume, and open interest. Those are the three main pillars, okay, or the three main aspects of technical analysis that we pay significant attention to in order to do our job much more efficiently. Okay, so price, volume, and open interest, and these are named in a sense by importance. So price is the most important, followed up by volume, and then open interest. Okay, so if you're looking at price action, if you're looking at charts, the most important aspect you need to pay the most attention, okay, at least the proportionally speaking, is the price action. Okay, volume is supplementary, open interest is also supplementary. Okay, please understand how to decipher one or let's just say decode what the price action is telling you first, and then use the volume and open interest. Okay, don't go open interest first, volume, and then price action. Okay, price action is the most important out of the three. Okay, so technical indicators are commonly used by active traders, whether you are a short-term, long-term, medium-term kind of trader, or you are a swing trader, a scalper, or a position holder. Okay, long-term kind of investor, where we're going to brand this. Okay, these are good tools that all these kind of classifications of traders use in order to make their life much more easy. Okay, some people don't use technical indicators at all. Fair enough. We would love to apply them to the chart because they give you valid information. Okay, so types of technical analysis. We have mechanical analysis, the category we just saw on the right hand side of the core of the slide, branded in yellow, highlighted in yellow. Okay, split into two. So we have on chart, what we call overlays, and off chart, what we call oscillators. Okay, there's some sort of mix up of the two. Okay, so we have on chart, which are moving averages. They go on top of price action. Bollinger Bands, again on top of price action. Fibonacci retracement, the one we're going to talk about today, also on top of price action. Where we have off chart, RSI, ADX, momentum, Williams R, there's plenty of them. Moving average, convergence, and divergence, the other topic of the day, also is off chart, so below price action, not on top of the price action, below on a separate window. Okay, so this is for you just to conceptualize, okay, where you're going to find this kind of stuff once you apply for your chart. Okay, making a start Fibonacci. So this is a historical kind of overview of Fibonacci in general, and then we're going to talk about the actual tool we use in technical analysis, the Fibonacci retracement tool, or extension or expansion tool, same thing. Once you understand the history and how this kind of Fibonacci sequence, okay, from a zoomed out kind of perspective, how it came forth, you can understand why we apply it on the technical aspect as well. So let's do a historical overview first. So Fibonacci sequence was firstly, at least that's what the textbook says, identified by an Italian mathematician named Leonardo Fibonacci in the 13th century. However, it's widely believed that the concept was not invented by him, it was introduced by Indian merchants, and we have seen some sort of evidence, historical evidence that the Fibonacci sequence was indeed discovered, quote unquote. Nobody actually knows, but we will give credit to these ancient Indians, okay, that have been using or have been identifying this back in the 6th century BC, okay? So the Fibonacci sequence is closely connected to what we call the golden ratio, the 1.618, okay? This is a ratio you can find pretty much everywhere in regards to beauty and aesthetics and what we perceive as human beings as some sort of harmonic kind of excellence, okay? That's a way to introduce this kind of thing, okay? And it's also known as the divine proportion, and it's interestingly found from my point of view, in pretty much everywhere, okay? In sunflowers, in galaxy formations, in shells you can find on beaches, on historical artifacts, in architecture, on faces, okay? On an anatomy of human beings, you can also find this kind of ratios, okay? It's pretty much everywhere, and for some reason we are calibrated, our brains are calibrated at identifying this and branding whatever we're looking at as kind of aesthetic pleasing or kind of divine, as the name comes out, divine proportion. Okay, so when it comes when it comes to trading, let's go out and talk about the Fibonacci sequence. Okay, we talk about Fibonacci. What actually is it? Okay, so in a sense, a sequence of numbers. Okay, and it starts. Primary components are 0 and 1, and in a sense, each subsequent number is the sum of the previous two. So you start with 0 and 1 and you add them together. 0 and 1 gives you 1, 1 and 1 gives you 2, 2 and 1 gives you 3, 3 and 2 gives you 5, and then you get 8, 13, 21, 34, 55, etc. Okay? So in a sense, you add the current number with the one prior to that, and you get a new number. You extend that into the future and it goes indefinitely, pretty much. Okay? So when it comes to trading, practitioners commonly use this ratio in a sense to establish support and resistance level. There's nothing scientific about this, okay? It's just we extrapolate by using this Fibonacci sequence, okay, and more specifically the Fibonacci and the golden ratio. Since we see it in nature, okay, as we just mentioned, we call the golden ratio as a divine proportion. Some technical analysts extrapolated back in the 80s saying we may see this kind of ratio turning out to be in price action as well. So therefore, that's when the Fibonacci ratios were created, and therefore the tools, retracement, extension, expansion, etc., using this kind of sequence by creating some sort of ratios, which they are using in order to, in a sense, identify potential levels where they're going to see price action breaking from, stalling, or rebounding from, okay, what we call support and resistance areas, okay? And that's how these ratios are primarily used in financial markets, okay, as establishing support and resistance level. There's nothing scientific about this. It's just more people use this kind of tool and more people see these kind of levels. They tend to create what we call the self-fulfilling prophecy. So more people see the same thing, they tend to act the same way, and therefore they create, in a sense, what they are doing, okay? Self-fulfilling prophecy, we're going to talk about this a lot as we progress through the series, okay? So what are the key ratios? They are the 0.618 or the 61.8% levels, the most important one out of the plenty of them that are out there, okay? The 0.382, okay, or the 38.2% level, and the 0.236 or the 23.6% level. Okay, even though the 50% is not a Fibonacci number because you cannot find it in sequence, and you will understand how you calculate these ratios in the next slide. 50 is not inherently in the Fibonacci sequence, but for some reason, because we're using it from a technical point of view, the 50 is considered as another solid support or resistance level or an indicator. Okay, so Fibonacci sequence, again, starts with 0 and 1, you add them together, you create a new number, and you do that indefinitely. We covered that in the previous slide. Let's do the Fibonacci ratios. Okay, they are found by dividing any number in the sequence by the number that it, in a sense, immediately follows it. Okay, so this is how you get the 61.8. And if you go ahead and do this number, let's just say the 34, divide that by, 21, divide that by 34, you're going to get 0.618. Let's do a calculation pretty quickly together. That's for visual illustration purposes only, don't worry. Okay, so if you do, for example, any given number, let's do 34, divide that by, where's the division? By, what's the next one? 55. You get 0.618, what we call this kind of ratio. Okay, so you can do this with, for example, 13 and 21. 13, divide that by the next number, which is 21. You get 0.619. Pretty much the same thing. As you progress through down the sequence, you get much more accurate, but yeah, same thing. And for example, if you want to calculate the next key ratio, you do, in a sense, you jump a number ahead. So not the one immediately following, but the next after that. Okay, so let's do, for example, the 21, divide that by, hopefully you can see it, didn't block your view. Okay, divide that by, what's the two numbers following that? 5. You get 381. Okay, or 3.2 if you average that upwards. Okay, so if you want to get the 23.6%, you in a sense do 3 jumps. Okay, I think it's pretty self-explanatory. Let's just, for the sake of it, just do it here. 21, okay, and divide that by 3 numbers down the line. Okay, so 54, 55, and 89. You get the 23.6. Okay, in this kind of case is 23.59. Average that or round that up is 23.6. Okay, that is how you calculate, in a sense, the Fibonacci ratios. Okay, 61.8, most important one, followed by 38.2, and then the 23.6. Okay, and once we have these ratios, we use these ratios, we plot them on our chart using the Fibonacci retracement tool in order to project into the future where the price action might stall. Okay, and use those kind of levels that the Fibonacci sequence or the Fibonacci retracement tool gives us as potential areas of reversal or breaking out from. Okay, target areas. Let me get my what is it called, pen, whatever that is. Yeah, pen. So you can see here we draw that from down here up to there, so 0 and 100. Okay, the full move. Assume that we have not seen anything coming out from here onwards. Okay, let's just assume that at this point in time we are right here. Okay, we go from the bottom to the top and it spits out. Okay, in essence, the Fibonacci retracement tool spits out the key ratios and you can see them clearly, and therefore you extrapolate that the price action is going to stall there or rebound from there. Okay, so you have the key ratios here. Okay, this is the 61.8, 38.2, the 50, and the 23, 50, 38.2, and then 23.6. Okay, and as you can clearly see from here, it kind of fits it kind of perfectly. We see price action falling here. Okay, breaking below these key areas, finding some sort of support near the 50 level. Once again, rising, but continuing its fall below that. But ultimately, we rebounded from the key Fibonacci retracement ratio, the 61.8, and once we saw the rebound and the 2 touches from there, price action moving to higher ground and breaking the 50 level, we have confidence that this is, in a sense, the end of the retracement. This is what we call a retracement. But we have a prior move, and then you see the price action, in a sense, moving the opposite way, but not completing the prior move, stalling somewhere, and rebounding from which you can call this area as retracement. This is what, in a sense, what a pullback is, the same thing. Okay, so primary direction is upwards. We see a stalling or a pullback or a retracement of the price action to the opposite side. And from there onwards, it extends its journey towards the initial direction, the main trend, which is upwards. Okay, that's why we call that a retracement. Okay, so Fibonacci retracement levels are drawn by connecting two extreme points on a chart by dividing the vertical distance by the key Fibonacci ratios. These are the key Fibonacci ratios. Apologize for not you being able to see this clearly. Hopefully I have a slide next. Do I have a slide? Yeah, much more clearly seen here. It's the same example. I'm going to look at it after we finish. Okay, so in a sense, these levels act as key support and resistance levels in the course of a retracement. Obviously, we're talking about Fibonacci retracement. So we, in a sense, have a primary direction, okay, which is upwards. We see the peak of that initial trend. From there onwards, we extrapolate that this is not going to be a complete reversal. We're going to be looking at a pullback or retracement. That's why we use the Fibonacci retracement tool to identify and highlight, in a sense, possible areas where we're going to see the price action rebounding from. It doesn't mean that it will for sure or definitely going to rebound from, but that's the reason why we draw these kind of lines to keep an eye on whether we're going to see a rebound or not. If, for example, the price action stalled at the 61, there is a pointer, give me 1 second. If price action stalled here and it didn't move upwards, obviously this is not a reversal, this is not a retracement. If the price action did something like this, this is a reversal. Okay, so anything breaking below the 61.8, you can consider that as a done quote move, and we're going to see possibly the complete reversal of the move. So started here, went there, come back down. This is what we call a complete reversal. If the price action stalls and rebounds and extends primary direction, this is what we brand as a retracement. And we can only brand this as a retracement once and if and only if the price action rises, okay, and heads to the primary direction. Okay, if it stalls here, it doesn't go there, it's not a retracement. Okay, it's just a temporary pause. There's many ways of classifying this. We can call it consolidation as well. Okay, let's not focus on the nitty-gritty details for the time being. Okay, so the 0% is the start of the retracement, where 100% is the complete reversal of the move. I branded this kind of differently, same thing from my point of view. 100 is, in a sense, is my mouse point. Yep, 100 is essentially this, and this is 0. Same kind of thing. If you understand the concept, no matter which is 0 and which one is 100, nobody cares. What we care about is the retracement levels. Okay, so it is not always about, it's not only, it's not only about upward moving kind of trends. It's also can be applied on downward moving trends, obviously. Okay, it's complete opposite, same thing. Okay, same philosophy, no same thing. Okay, so 61.8 are the key, is from my point of view, the key retracement kind of ratio, followed by 38.2 and less significantly so the 23.6. Okay, again, each one of those kind of, if you see rebounds from this kind, any of these kind of levels or ratios, they have different connotation to it. There's different interpretation to it. So the sharper the pullback closer to the 61.8, the less chances you're going to have a quick rebound. Okay, but for example, if you have a pullback near the 23.6, this kind of the first one in a sense, and you see the price action doing this, obviously you kind of call this as pullback. Okay, so actual pullback is 61.8 from our point of view, 50 as well. Okay, so moving on to the next. Okay, it's an interpretation of what we're talking about here. So Fibonacci retracement are in the sense of method of technical analysis for determining support and resistance levels. Please, I'm gonna say this a million times. If I bore you, please bear with me. Okay, so support and resistance levels, that's why we use Fibonacci retracement. They are not providing you with any sort of guessing or forward-looking kind of capabilities of where the price action is going to move towards the next, you use them for support and resistance level. Nothing is going to tell you, no indicator is going to tell you where the market is going to move towards to next 100% of the time. Okay, we're dabbling in a sense with probabilities here, and that's why we use the Fibonacci retracement tool as merely a tool of identifying support and resistance levels. Okay, they are named after the use of the sequence, the Fibonacci retracement tool. So Fibonacci retracement is based on the idea. Okay, it's not a rule, it's not a law, it's an idea, it's a philosophy, it's a theory or a hypothesis, much more accurately. Okay, that the markets will retrace a predictable portion of a move, after which they will continue to move in the original direction. And this makes sense because you don't see price action in the market doing this and only these and continuing upwards from that. Okay, you have a zigzag kind of element to the nature of price action. Okay, so this is where the usage of Fibonacci retracement comes into play, because you extrapolate the price action. Yes, moves up by an X amount, then retraces by smaller X amount, and then continues off from that kind of level. Okay, that's why we use it. So Fibonacci retracement is created by taking two extreme points. Mentioned that 0 and 100. Start of the retracement is 0, and 100% is the complete reversal. And how do traders use this? Okay, as one of the most common technical indicators out there, strategies, traders could use Fibonacci retracement level to indicate where they would enter a trade. Okay, again, support and resistance levels, you can draw confidently support and resistance levels as a start. From there onwards, you make your base case scenarios kind of thing. You make a scenario allocation, drawing in a sense, where the price action is going to move towards the next. And you enter the trade once you have the odds or the probabilities of your scenario coming into fruition. Okay, so it's a game of probabilities. Okay, so the better you are at judging and assigning probabilities to your best case kind of scenario or the worst kind of case scenario, the more sophisticated your approach will be, and from there onwards you can, in a sense, make more money and safeguard your profits but also your losses. Okay, so for instance, a trader notices that after a significant momentum, a stock has declined to 38.2, a key ratio. As the stock begins to face an upward trend, they decide to enter the trade. Okay, because the stock has reached the Fibonacci level, is deemed as a good time to buy. And this is not only for the 38.2. Again, I mentioned that you have different interpretations of where the price action is stalling at, whether that is the 38.2 or the 23.6 or the 61.8 has different implications. Okay, again, if the price action pulled back towards the 61.8% level, rebounds from it, it's going to take a lot more time to get up to the prior high. Okay, obviously, if it's near the 3.6, it's going to be much more easy for you to cover the ground and move to higher. Okay, so there's many ways of interpreting this. Okay, so the deeper the retracement, the more time it will take. The shorter the retracement, the much more easier it will be for the price action to move to higher. I'm not saying something that is not easily observed by you guys. Okay, it's pretty much a basic observation what I'm doing here. Okay, so they are simple concepts. You need to digest them as soon as possible, because obviously you can use that when it comes to your trading. It's super easy to do. Why not? Okay, so some traders also combine other key data provided by other indicators to confirm whether the expected move will be played out by rationalizing probabilistically rather than taking levels provided for. Okay, so please do not use Fibonacci retracement tool by itself. Okay, it gives you some sort of information, but please double check with other technical indicators. Look for the convergence of different indicators. What are they all telling you? Are they telling you the same thing, or you have divergence between the indicators? That's why you use a few indicators to validate or disprove your biases. Okay, so please do not use Fibonacci retracement by itself and again think that it has predictive powers. It does not. I'm sorry to disappoint you. please use other stuff as well. Make your charting analysis, do your mechanical analysis as well. Put indicators on your chart, not too many, but you can find the golden ratio once you start practicing, but please use other stuff for validation. Okay, so pretty much we've done this much more clearly seen here. The 61.8, the key ratio, and you see 1, 2 touches, what we call a double bottom. Okay, price action in a sense rising once again towards the 50 level. Not a key Fibonacci ratio, but we use this in trading because obviously it's the halfway point between a prior move. Okay, this is the pointer. Sorry guys. End of the move, start of the move, 50s, and the bloody middle. Okay, so it has some sort of significance. It's not a Fibonacci, a ratio that can be constructed from the Fibonacci sequence, but it's halfway point. It's important. Okay, once you see the price action raising and breaking above this, you have lovely confirmation. Okay, from my point of view, most how we're going to call this cautious and safe kind of approach. I would love to see the rebound. Yes, the double bottom. That's one step. Thank you very much. We're going to see the break above the 50 and how easy it breaks above the 50. And from there onwards, I'm looking to enter somewhere near here. Okay, clearing in this kind of case. Okay, this prior high. Okay. Once I see the break above this kind of level with significant volume, and it happened in the past, I see this key area for entering the trade. Okay, where you're going to have target, you're looking for a short-term kind of point of view, obviously it's going to be the next key Fibonacci ratio. Okay, so you enter, for example, near 38.2, and you exit, and you have a target profit somewhere in there. Okay, this is one of many ways to play this. If, for example, you miss this kind of move, you saw the price action rising here, and then coming below that, I would look to enter again near the same level, the 38.2. If I see this lovely consolidation taking place above this level, so an entry point would be somewhere here. After I'm confident that the price action, if I miss this move, next level to look at is whether you're going to see some sort of consolidation taking place, where in a sense you turn the 38.2 prior resistance level into a support level. And again, these are support and resistance levels. I'm sorry to repeat this time and time again, but please digest this. After that, again, same thing, enter here, have an exit here, or if you want to let, in a sense, the move run, you have the target up there, or from a technical point of view, combining other stuff to the chart as well, I'm looking at this level once again and this level once again, which kind of align. See this, okay? Form a high, she's gonna definitely act as a resistance, not definitely, but has a chance of acting as resistance. Another high, okay? They are the same level, so that's an area that I will be looking closely. Okay, you can see clearly here being retested. Okay, and we see the price action of this instrument, which is, what is it, Kiwi against the dollar. So New Zealand dollar against the United States dollar. You see the price action stalling 1, 2, 3 times. Okay, hitting the ceiling and coming backwards. So in this kind of case, exit could be somewhere here. Okay, so but at the end of the day, I brand this from a zoomed out kind of perspective. This is the main direction. This is charged and is branded as a pullback, and we are extrapolating the price actions to move from there onwards and extend above this. Okay, so this is the zoomed out perspective, and then I zoom in and look at these key ratios and how can I play this from a short-term point of view. Or again, if you are you have this kind of swinger kind of vibe to you when it comes to trading, in a sense, okay, you in a sense play the long game by, there is a mouse pointer, once again I've lost it. Okay, you see this formation here above the 61.8 is going to be good enough for you to enter a trade. Okay, and expect this. Okay, if you are a much longer when it comes to a time frame kind of trader. Okay, again, there's many ways to play this. We don't have, unfortunately, we don't have enough time to go over all of them, but this was this pretty simple illustration. Okay, same thing goes the other way. You can, instead of going long, you're going to do short. You see the complete move, start here, end here, pull back, and you see them not reaching the 61.8. So it was a shallow pullback or retracement, or in this kind of case, rebound. Okay, so once we see 1, 2, 3, 4 times price action failing to break above 31.2, 38.2, excuse me, very, very nice signal, very, very strong signal. Okay, again, from again, my cautious point of view, I would love to enter a trade somewhere in here after breaking this former level. Okay, but if you are in a rush and you want to risk more, 1, 2, 3, 4 touches somewhere in here, you may enter. Okay, and again, you have a target. This area was here. Okay, the former level where we saw the price action starting at. Okay, 3 touches. Maybe you have a target here. Okay, short position here, either on this level or this level, and you have a target area here. Okay, and you see a price action not going well below that. And again, these are not exact lines. Okay, we're talking about levels. Same thing we just mentioned when it comes to drawing support and resistance levels. These are not merely used as lines. For example, the 6.937, whatever that is. No, use them as blocks, as ranges. Okay, much nicer. Okay, gives you leeway as well to act upon this kind of information. Don't, oh, it has pivoted away from these exact levels, the 7.09, what is it, 09130, whatever that is. Fair enough. Okay, it's important, yes, to fixate upon pips and points and everything. If you are a short-term trader and you are in a position for, I don't know, 3, 4, 5, 10, half an hour, okay, minutes and half an hour, whatever that is, yes, it's important. But when we're looking from a much more broader point of view, my own biases, and look at this kind of things as from a little bit more zoomed out perspective, you don't care that much about pips and points and everything. Okay, but the point is to understand how the whole thing comes into fruition. Okay, so you see the price action falling below the former low. Okay, rebounding from it. Again, I'm going to be looking closely at the first level. Okay, 38.2. It has acted in the past as resistance. Once again, it's done the same thing. Now I have much more confidence and I can enter a trade much more quicker, because you have 1, 2, 3, 4 times. You see continuation. Okay, price action falls below and rebounds from it. Okay, I'm looking as a hawk this kind of level, and I'm, as soon as I see the price action attempting to break above it, but then coming back down, I'll have much more confidence of placing a short order somewhere in here. And again, you can play the same thing, have a target area here for an exit, or again, if you are willing to risk more, or at least keep the position open for longer, you extrapolate and the price action is going to move to lower. Okay, in a sense, continue, where is the mouse, continue its main direction, which is downwards from here. Okay, you can call this as a stalling area. Okay, from a zoomed out perspective, you can call this as a consolidation area, okay, or a trading range, whatever that is. Okay, but at the end of the day, you have the eye on the ball. Price action is going to head towards the primary direction after this brief setback. Okay, happen once, happen twice. Okay, okay. So you can do the zoomed out perspective and zoom in and zoom in much more further in order to calibrate your entry and exit points accordingly. But again, you need to do the macro first to get the grasp and then zoom in. Okay, don't just zoom in, and it's much more nicer to do the overview first and know where the market is heading. Therefore, you start by biasing from the beginning towards a short order rather than a long order. Depending, you can scalp this as well. Once you see, for example, you can play the contrarian kind of view. Once you see the price action falling down here, consolidating 1, 2, 3, 4, 5 times, and then breaking back once again in trading range, you can go long here, but you're gonna be, when it comes to your time frame, you're gonna be less, not resistance, you're gonna have less patience, okay, for a long order if you're playing this, okay? You're not gonna be long buyers for the future, for the immediate future, for a longer time period. You're gonna be in and out quickly, okay? Because you're going against the trend, and it's something that you need to learn from the beginning. Please do not do this. Trade with the trend. And trend is your friend and all that kind of stuff. It makes sense because it's a basic observation. Okay, so you can go long here, for example, and once again have this level, 38.2, as your exit. Okay, so this is your entry point after you saw this being formed. Enter here, exit here as a target. Okay, and obviously this is not a line, this is an area. Once again, do not put your take profits right where the price action has pivoted in the past. Please allow and give some more room in order for your order to be executed, because if it doesn't reach exactly the 7.0931, whatever that level is, you're not going to be executed, and from there onwards, if you're not paying attention, you're going to lose, you're going to leave a lot more money on the table, okay, which you could have, in a sense, put it back in your pocket. Okay, so allow some sort of degree of fluctuation, okay, when it comes to your take. Place it a little bit lower than that, okay. Obviously, same goes for stop losses. Okay, so I think it's enough with Fibonacci. Let's move on to MACD. We're running out of time. So moving average, convergence, divergence, one of my favorites. I have to get it out there. I like this a lot because it gives you a plethora of indications. Okay, you will see when we're going to start interpreting these and breaking down what kind of information goes into the MACD and what does it spew out, what kind of information does it tell me, okay, how I'm going to be interpreting this. Okay, but first we need to understand, okay, what goes in the indicator in order to understand what kind of information does it give me, okay, and what information does it not give me, which is even better. Okay, so MACD definition, textbook stuff. Let's do the intro. So the moving average convergence divergence is a trend following, please digest this, a trend following momentum indicator that measures the relationship of two moving averages. We have covered in the past what moving averages are. I'm not going to go into this because we don't have enough time. You can watch the webinar at your own time. These are super simple concepts. Okay, moving averages. So it's a trend following, okay, momentum indicator. Trend following, please digest this. This is not telling you anything about what's going to happen into the future. Please do not use this information as like a glass ball predicting kind of thing that tells you what's going to happen in the future. No, it's a lagging indicator. It compiles information from the past. It has nothing to do with what's going to happen into the future. Again, I don't know any technical indicator that gives you indication about what's going to happen in the future. In a sense, we take what we have from the past and we extrapolate by making scenarios what's going to happen in the future, using the principles that the market are predictable and moves in certain ways and retraces, etc. Okay, so trend following, it does not tell you where the trend is going to move towards to next. It's telling you from where and how long it took the trend to come up until this point. Okay, so you're dealing with lagging information, not leading information, lagging information, compiles information from the past. Okay, so it is in a sense a momentum indicator and is used to spot changes in strength, direction, momentum, and duration of a trend. Okay, so you have 4 dimensions, if you like. Okay, so of any given trading instruments price. Wherever you would like to trade, MACD is going to calculate it for you. Okay, it doesn't care about where you're looking at. Okay, there's going to be some sort of calibration in regards to the time frames that the MACD uses. You're going to see them soon. But you can adjust those kind of parameters to, for example, the life cycle of a commodity, because you have cyclicality in commodities market. You can adjust those parameters to match the trajectory or the cyclicality of commodities and have it much more accurately calibrated or optimized in a sense. But MACD can be used on anything, okay? Whether that is crude oil, whether that is gold, whether it's silver, whether it is an equity, whether it's an index, whether it's an FX pair, everything, okay? It compiles information from the past because it's a moving average kind of indicator, using moving averages, okay? So once it's added to the chart, it can be found at the bottom, okay? Not on top of the price action, just like the Fibonacci retracement we just saw, where you see lines above price action, goes below the price action, okay, on a separate window, okay, it's an oscillator in a sense. So once it's added to the chart, it can be found at the bottom of the price action, since it is an oscillator, which essentially measures the strength of the prevailing, okay, so it indicates where the direction of the trend is moving towards, to is an upward or a downwards or a sideways kind of price action. Sideways movements are not ideal for MACD, so that's one problem of MACD. So if the market is not trending, please don't use MACD. Once you have clear direction of the market, whether upwards or downwards, you can use MACD to confirm, okay, what you cannot, if you cannot spot that by your own, you can confirm that with the MACD, okay? So it measures the strength of the prevailing trend along with signals. This is what we're going to be looking at. This is what we care about, of the change in a trend, okay? If you cannot spot a trend shift with your own naked eyes, MACD can be helpful. And that's why we use it, because it's a trend following momentum indicator. Okay, so it can be plotted as a histogram, which moves above and below the baseline. We're going to see what a baseline is, showing strength and weakness in price. Okay, so MACD is used by all types of traders, whether you are a position, swing trader, day traders, and more, since the indicator can be applied at any time frame. But it's primarily used by medium to long-term traders because you have much more clearer signals or signs provided by the MACD compared to someone that uses it on a smaller time frame, because MACD is going to be skewed a lot. It's going to be all over the place. So you need that kind of long-term perspective when it comes to MACD in order for you to, in a sense, erase the unnecessary noise or volatility or fluctuations, the erratic movements that you do see in shorter time frames. Okay, you can be used on shorter time frames as well. So something to remember, please do remember this. If it's something you will remember from this slide, please be this. It's based on moving averages. It's a lagging indicator. Do not fall for the trap that it's future predicting. Please do not. Okay, compiles information about what happened in the past. Okay, so furthermore, MACD is less useful for instruments that are not trending or are trading erratically. Trading erratically, talking about something on a shorter time frame, whether that is, for example, I don't know, crude oil is infamous for making volatile, sharp movements up and down. Not that kind of ideal. If you do WTI and short time frame as well, MACD is going to be all over the place. It's going to give you million signals, and you don't know which is reliable and which is not. You can adjust that accordingly, but yes, okay. And not trending markets are something else. Okay, for example, if you pull up a chart of silver, my God, this is a non-trending definition of a non-trending kind of instrument from my point of view. It goes on a sideways motion for months. You can capitalize upon that, but not by using moving average, convergence, divergence. You can do CCI, commodity channel index, on silver, which is super nice because moving average, convergence, divergence it's optimal for trends, either upwards or downwards, whereas you have different other indicators, for example, CCI or Williams, which are primarily used for instruments that are trading within a range for a prolonged period of time. Okay, so using any given indicator, understanding what indicator has as strength and what has as weakness, you can use them accordingly. So trending markets, MACD, go to. When you have non-trending markets or sideways price action or trading ranges, you can do CCI, okay? And we will discuss what CCI is in future webinar, okay? Ideal for not trending markets. And you can capitalize upon this kind of sideways price action, okay? Buy at the bottom, sell at the top, sell at the top, and buy at the bottom, okay? Channel trading in a sense, scalping. Next time. On that days we're running short. Okay, so moving average, convergence, divergence takes two trend following indicators. Again, moving average using the name. Point is we need to have them at two different time frames in order to give us signals. So if you do MACD and you have both parameters of the long and the short, moving averages being both 12, no point in that. So you need to have a difference between time frames. So most people use 12 as the short moving average, short-term moving average, 12 periods, and 26 for the long-term moving average, long-term, quote unquote. Okay, 12 and 26 are the basic default kind of parameters, those numbers you feed into the indicator to give you the clues. Whereas other people adjust them accordingly. For example, you can do 10 and 24, you can do 15 and 40. There's a million things, whatever. The point is you need a short moving average and a long moving average, okay, in order to see the crossovers between the lines, okay? And those crossovers between the lines are telling you whether the market has shifted, okay? The trend has shifted, whether the primary trend is coming to an end, and we're going to see a kind of reversal, okay? That's why you use two moving averages. And this specifically, more people are becoming increasingly convinced that for some reason, the exponential moving average is much more accurate compared to the simple moving average. Covered this in the past. Let's not go into this once again. Okay, so EMA is in a sense calibrated for the more sooner status of the price action, whereas simple moving averages is in a sense you take 12 periods, okay, 12 period values, add them all together and you divide them by 12. So there's no weighting to these to the number that it spits out, whereas exponential moving average, if you have 12 periods, it places much more emphasis on the last, let's just say, 4 or 5 days. So day 9, 10, 11, and 12, they get more weight into the equation compared to the 1, 2, 3, 4, 5, 6, 7, 8 prior days. Okay, so hopefully I'm not confusing you, but super easy concept. You can look up the moving average kind of webinar we've done in the past, explain that in much more detail. Okay, so due to the lack of time, we have to skip it. Okay, so when the MACD crosses, in a sense, what we call the zero line, which is the line that you can see right here. I don't know if you can see clearly. Okay, so we have in a sense the baseline. Okay, so 0, this is the threshold, the color point. So if you see the moving average, the MACD, okay, crossing above 0, so this is above 0, you can see the green histogram above 0, it indicates positive momentum. Okay, so if the trend is moving upwards and you see the MACD being above the 0 line, okay, and it has positive and green histogram bars, that means there is an acceleration towards that direction. In other words, there's strong or a positive momentum around this price action. But when it falls below the 0 line, it indicates there is negative momentum. There's pressure of price action. Price action is not rising as quickly and as sharply and as with strong momentum towards the upside. Okay, stalling in a sense. So the trigger, you can see this a lot, the trigger or the signal line is a 9-period exponential moving average of the MACD. So something else to remember is that the MACD is in a sense the difference between the 26 and the 12. And you also have the third line, 2 lines plotted on a chart, which is a 9-period exponential moving average, which, we call a signal line. Again, if this is not clear enough, Fear not, we're going to see this in detail on the next few slides. So crossovers between the trigger line, okay, you're going to see it's going to be the red line in the next chart, are used in similar fashion as crossovers between two moving averages. Okay, so once you have, without MACD, okay, when you have two moving averages, you have short and one long. Once you see the short moving average crossing above the long moving average, the long-term moving average, creates, in a sense, the signal we call the bullish crossover, or in other words, the golden cross. Whereas once you have the short-term moving average crossing below the long-term moving average, in a sense, this generates the signal known as quote-unquote death cross or bearish kind of cross. Okay, and it has different implications. The first one gives you bullish indication, obviously you go long, that's what it says, and then the latter one, it says go short. I'm not going to complicate this any further. Let's move on. So the indicator shows blue line and red line. You can change the colors of the lines, by the way, as you see fit. The point is the default is blue and red, so we're going to refer to this as blue and red. So it has a blue line and a red line, but also a histogram bar, which evaluates, which calculates the difference between the two lines. So difference between the blue line and the red line is, in a sense, the histogram. Okay, so values are calculated from the price of the trading instrument in the main part of the graph. So MACD line is, in a sense, what we call, basic words, the blue line, which is the difference between the 12 and the 26 exponential moving average. Okay, so the MACD is the difference between the two periods we have selected, the 12 and 26, which are adjusted accordingly to your needs. Okay, so the signal line, the next line, so this is the first line you're going to see on MACD, and this is the second line. Okay, first one is MACD, the next one, which is the difference between 26 and the 12 and 26, and the next one is the signal line, which is red line, again, change the color accordingly, okay, which is the 9-day exponential moving average of the blue line. Okay, so in a sense, we have three different time periods, 12, 26, and 9, and we use these parameters in order to generate signals given by the MACD, and the interrelationship and the value of each and every line tells you the story. Okay, so the histogram bar is the third aspect of the MACD. So you have 1, second, and this is third, 2 lines and 1 histogram. The histogram is, in a sense, the difference between 1 and the second. Okay, please bear with me, you're going to see clearly. So the period for the moving average in which MACD is based can vary, but most of the times, or most commonly, the most common parameters involve a fast EMA of 12 days or a slower EMA of 26 days. Again, default settings are these, and for the signal line is 9. So when you hear someone telling you, or asking, for example, what are your MACD parameters or your MACD specs, you're going to say MACD, for example, 12, 26, and 9, and this is in this kind of format. So short, long, sigma. So the difference between this and this gives you the MACD line, and the other one is the 9, which is the red line, which is the signal line, which is a 9-day EMA of the blue line. Blue line is the difference between the two. Remember this. Okay, so now that we have decomposed, in a sense, what is this? This is a visual illustration of how you can capitalize upon this kind of information. Okay, so remember, when we said you have a crossover between the blue line and the red line, okay, it gives you a signal. Okay, so blue line, red line, crossover right here. What can you observe from this? By the way, this is MACD, this is price action A. Okay, so it's going to be below. What I've done here is I have added the same, okay, parameters, the 12 and the 26 moving average, which, okay, on as simple as moving averages above the price action as well. This, if you plot a MACD chart, a MACD technical indicator on your chart, you're not going to have these lines. You can see my pointer. You're not going to have these purple and black lines on top of price action. You have to, if you like, place them on yourself on the price action in order to, they have, in a sense, some sort of validity. They have, give you different indications as well. Okay, so what you're looking at here is a MACD, but also two moving averages, which can be used as a simple strategy as well. Okay, so what you observe when you see this kind of crossover, in a sense, the blue line crosses above the red line, generates a signal. What you can observe is that the histogram, you can see this, the histogram levels out. So the histogram at the point of the blue line crossing the red line is always 0, okay, because it indicates the shift, okay, in the strength of the momentum. Okay, so this crossover is what we call bullish crossover. I'm gonna attempt to write bullish here. Not that good when it comes to this kind of writings. Okay, so a bullish cross, C and O means crossover. Okay, so a bullish crossover is when the blue line cuts above the red line, and the flip side, blue line crosses below the red line. This is what we call a bearish. Yeah. Okay, bear is enough. Okay, so it's a bearish crossover. This is what we call a golden cross. This is what we call a death, by dying, death cross. Okay, so signal is this. Once you see the blue line crossing above the red line, you flag it as a potential for an upside kind of move. So you expect to see some sort of bullish momentum coming into the picture and price action rising. Okay, and you can clearly see it kind of taking place here. Obviously, this panel here is a manifestation or is a creation of pure price action. Okay, I mean the moving average, the average of price action. Okay, so movements are going to happen first here and then here. Okay, so price action precedes the MACD indicator. Again, this is not telling you that the shift is gonna the trend is gonna shift. Okay, it tells you that the trend has already shifted. Okay, due to the price action. Price action is first, and then the MACD confirms it. Please digest this. Okay, so it's not telling you beforehand that the price action is going to pivot or shift. Okay, it gives you the confirmation that it has already shifted. Okay, so the price action precedes the MACD indication. Okay, so once we see the crossover, however, this is the visual illustration that is provided by the MACD, and it's important. Once you see the crossover, signal that, you know what, we may go long, we can go long here because we see a shift in trend. Okay, there's bullish momentum coming into the picture. So from here onwards, at this point in time, we may be somewhere in here. Okay, so go long here once you see the break above, okay, of the blue line above the red line. Okay, so you get positive histogram bars. Okay, and using purely the MACD, you can time your exit as well. Obviously, it's going to be much better if you use, for example, other technical indications. For example, use this level. Yeah, it was supposed to be a straight line. It is not, sorry. So use this level if it has been in the past as a resistance level. So draw support and resistance level. Use different indicators to confirm that this level is gonna play a major role in the future, blah, blah, blah. Okay, so but by using only the MACD, the signal for exiting is once again when you see the crossover of the blue line below the red line, which is hopefully that is somewhere in here. Okay, this is where the signal was for you to exit. Okay, when you see the blue line crossing below the red line once again, then you see histogram turning red. In this kind of case, it does not have a color, but if you had colors. This was supposed to be red. This was supposed to be green. Okay, so once you see the zero line, once you see the price action, excuse me, once you see the histogram bar recording a zero value, this is your signal to exit the position. Okay, and if you did this, you would have lost quite a lot of money, and we would have left a lot more money on the table compared to if you have used, for example, other indications. For example, RSI, it's pretty decent when it comes to timing your exits, or plotting support and resistance levels in your chart beforehand. For example, the price action might have stalled in the past here. So you use this level as an area for you to exit, okay, rather than waiting for the MACD to give you the exit signal. Okay, so I think the philosophy is pretty much the same. Okay, so once you see the blue line crossing below the red line, this generates a sell kind of signal. So yeah, so you can do the same thing here. So enter position here as sell. Okay, go short in a sense, and look for when the MACD once again zeroes out, and you see moving average, excuse me, the histogram losing momentum in a sense, losing strength, zeroing out, and then positive. Okay, so you use this kind of area, this crossover, for you to exit the position. Let's assume it's somewhere in here. So short position there, cover the position here, and obviously you can go long here because you have the bullish crossover once again, and then you look for the bearish crossover for you to exit your trade. The bearish crossover has happened up here. Okay, let's assume you went somewhere in here. So you went long here, you covered your position here. Okay, and once again, long here, short here, close the position, and then you go short position once again and look for the next crossover. Okay, which is, let's just assume it was somewhere in here. Okay, so cover the position by going long. But if you went long here, would have been for quite some time in the negatives, because we see this kind of fake out in this kind of thing. Okay, the most optimal, the optimal level for you to enter this kind of position was obviously at this kind of thing. And that's why you should not place 100% of your faith in this kind of indicator. Okay, you need to judge how the price action is behaving first, and then consult with the MACD for confirmation. Don't use this blindly. Okay, please do not. And you can see clearly here why. Because if you went short there, cover your position there, and then you've done exactly the same thing as you've done in the past. You close, you cover your position, and then you opposite there, and then you open a position on the opposite direction. You would have been in a loss here. Okay, straight away. So what's the point of doing this? See how the price action is behaving first, and then enter the position. Okay, you have been in a loss here. Yes, it recovered from that, but why bother and why go through the whole hassle of entering a position prematurely and being in the reds and stressing about, oh, when it's gonna rebound and cover my losses in a sense and move the direction I wanted? Why go through that phase when you can judge beforehand, be cautious, be let's just say much more patient in a sense, get what the actual market is telling you, understand how the price action is behaving, and then doing it. Okay, it's much more nicer. Okay, it's hassle free. Please use this way of thinking in your own trading as well. Please do, please do. It's much more nicer for your mental health, well-being. Okay, please do this. Okay, so once again, treat this as a bullish crossover. It appears, and you can see here, zero. Okay, fade out. Momentum goes from negative to positive, goes to the zero level, which is, let's just say somewhere in here. Go long here and capitalize on the upside, awaiting for the next crossover. If it happens like that, okay? Sometimes it might not, might run for a bit. Okay? At the end of the day, you will use this kind of level as target straight from the get-go before even looking at it. okay? Because you use price action first, and then MACD as a supplemental tool, okay? I'm gonna stop saying this, I've mentioned this a million times. So, in a sense, this is in a verbal kind of form, how you can use the MACD. Let's go ahead and read over it. I don't have much time anyway. So exponential moving averages highlight what we call the recent changes in a trading instrument's price. That's why we don't use simple moving averages. We use exponential. Okay, they have their benefits. Now, by comparing EMAs of different lengths, the 12, the 26, and the 9, the MACD line gauges changes in the trend of an instrument. Okay, this is what essentially the crossovers we have highlighted in this kind of chart are telling shifts in trend, at least short-term or intermediate shifts in trend. Okay, so by then comparing the difference of the change of that line to an average, analysts can identify subtle shifts in the strength and the direction of an instrument's trend. Okay, something else I failed to mention is that the larger, okay, the bigger the histogram bars, the more confident you are that the strength, the prevailing trend, the move of the prevailing trend is going to be stronger. Okay, so the larger the candles, the larger the histogram bars, more confident that you are that the price action has enough momentum to propel itself to higher ground. It means there is a strong buying interest, which is going to push prices at the higher level faster. Okay, compared to a histogram that has small bars. Okay. What else? Now, traders recognize 3 meaningful signals generated by the MACD indicator. I don't know if I've mentioned all of them. I've mentioned the most important ones. Let's see them here. So when the MACD line, the blue line, crosses the signal line, so we just mentioned red line, blue line crossing the blue line, the blue line crossing the red line, MACD line crossing the signal line, first signal. The MACD line crosses the zero level, which is what I didn't mention, which is this. Okay, you see the blue line cutting above the red line, MACD crosses above the signal line, and then it crosses over the threshold. This is a lovely indicator, a lovely indication, a lovely signal, which is in a sense what two moving averages are telling you, like right there as well. Okay, so when you see the lines, the MACD line crossing above the zero line, which is the threshold, okay, above the zero line, green histogram bars, below the threshold, the zero line, you have negative values. So when you see the line, the MACD line, the blue line crossing above the zero level, gives you the most reliable buy signal. Okay, it's more reliable compared to this early signal that we have received from the crossover. Okay, so this is in a sense the confirmation. Okay, so if you want to act up quickly, you go long here when you have the bullish crossover, and you get the confirmation when you see the MACD line crossing the zero line and staying above it. Okay, this is your validation. This is right here your validation. Therefore, you stay in the game for longer. Okay, if the price action fails, if the MACD line, the blue line, fails, okay, to cross the threshold, okay, the zero line, and does something like this, then you can treat that as an exit signal. So you go long here and you see the price action, you see the MACD line, the blue line, not being able to cross over the zero line. You treat that as an exit signal and you exit the position here because the price action will most likely be down here already. You can visually see that beforehand because once again, price action precedes the MACD. The MACD averages out the price action you have on top, not the other way around. Okay, so again, 3 meaningful signals. We have MACD line crossing the signal line, yeah, the crossovers. MACD line crosses the zero line we just mentioned, and there is when there is divergence between the MACD line and the price of the stock, between the histogram price and the price of the stock. We have this on a visual illustration. You can see here, price action is making higher highs, higher lows, some sort of higher high there, higher low there, higher high, higher low, higher high. Something happens here. And you can see the trend here. Yep. Moves upwards. Okay. Pure price action creates higher highs and higher lows, higher highs and higher lows. That's why we deem this an upward moving instrument. Okay, moves in an upward manner. Okay, but when you inspect the MACD indicator below your chart, it tells you a different story. The higher highs and the higher lows do not coincide between price action and the MACD. And you can clearly see here, this is what we call a divergence. It's in a sense an early signal that the momentum and the strength of the prevailing trend upwards is losing ground. Okay, and you will see, and you will have a sharp pull down afterwards, a pull back, excuse me. It's going to see a shift in trend. There is a build up, okay, coming into fruition. The MACD indicator below tells you about it before it actually happens, okay? And when we see, when I say divergence, again, you see higher highs, higher lows, higher highs, higher lows, yes? MACD does not paint the same picture, okay? So you have a high here, a low here, a lower high, not a higher high, okay? A lower low, and even lower high, okay? A lower here, okay? So you see the highs of the price action do not correspond with the move of the MACD. So MACD has lower highs, okay? Whereas the price action has higher highs, okay? This is what we call, in a sense, a divergence, and we pay significant attention onto this because it's an early sign that, you know what, something is going wrong. Price action, the momentum, okay, the strength showcased by the MACD is telling you that the bullish momentum is draining out much more quicker than the price action, and you're going to see bulls evaporating kind of quickly, and the bears will enter the picture and push the price action to lower ground. It means that the bears are entering the picture more and more and more after each and every pickup of the price action. Okay, you see a build up of the bears in here, and after you see the definitive break below. Okay, see the price action, excuse me, you see the histogram bar turning red, and the lines, the MACD lines, okay, crossing the zero level and making a fresh low. You see, this is a low, this is a low. You can treat the MACD indicator as the same way you treat price action as well when you identify a trend, okay? Low here, low here, low here, lower low here, okay? This is an imminent signal telling you get out, okay? And this is what follows. A shift in trend, okay? MACD told you about it many times before you lead up to this point. Many times. The point is to pay attention to this. Is the MACD coinciding or has convergence with the price action? Yes or no? If yes, play accordingly. If no, pay significant attention if you are long biased, and you are long biased because the price action is heading to high ground, making higher highs and higher lows. But pay attention because we expect to see the bears entering the picture due to the creation of this negative divergence. Higher highs, higher lows, lower highs are created here by the MACD. It's an early indication. You have to be able to spot this on the go. Okay, practice makes perfect. So please pay attention to this as well. Keep that on the back of your mind. So these are the three most powerful signals when it comes to MACD indicator. So crosses, MACD crosses signal, MACD crosses zero, and there is divergence between the MACD and the histogram price action of the stock. Okay, so graphically, from an illustrative point of view, we saw that blue line is crossing the red line when it comes to MACD crossing the signal line, the simple crossover in a sense. Blue line is crossing the x-axis or the threshold or the zero line. Blue line means the MACD, not the signal line, not the red line. the blue line crosses the MACD, blue line crosses, excuse me, the MACD line crosses the zero line, okay? MACD crosses the zero line, MACD crosses zero. We don't care about the signal, we care about the MACD line, the blue line crossing the x-axis, the threshold. This is the second signal. This is how you can visualize this graphically, okay? And the last one we just priorly mentioned, higher highs and lower lows on the price graph. Remember this, higher highs, high lows, high highs, high lows, whereas blue line or the MACD line is recording not higher highs and not higher lows, okay? It can record higher lows, not higher highs, okay? Hopefully it's pretty simple, okay? So, of course, we have to finish up quite quickly. This is the last slide, guys. So the signal line crossover, one of the most used ones, okay? Signal line crossovers are primary cues provided by the MACD. So we're talking about blue line crossing above or below the red line, okay? So the standard interpretation is to buy when the MACD line crosses up through the signal line, blue line crossing above the red line, buy signal, whereas when the blue line crosses below the red line, you sell, okay? So this is what we call the bullish. This is the first example. Okay, I'm not going to write bullish. And the bearish, okay? Those are the early signals. The confirmations are with the MACD line crossing above or below the threshold, the zero line. Okay, so the upward moves is called the bullish crossover. Yeah, just like other. Okay, so respectively, they indicate that the trend in the instrument is about to accelerate in the direction of the crossover, and the histogram shows when the crossing occurs. Again, when you see crossovers between the blue and the red line, histogram records a value of 0. Okay, so since the histogram is the difference between the MACD line and the signal line, it's obvious to get a 0 line. There is no difference between them, the 0 value we just mentioned. So the histogram can also help visualize when the two lines are approaching the crossover. This is what we're talking about. Okay, this fade out. Okay, this one as well. Okay, so though it may show a difference, the changing size of the difference can indicate acceleration in the trend. Again, the larger, once you have the crossover of the MACD line above the signal line, and you have big histogram bars following shortly after, expect sharp appreciation of the price. Okay, so it gives you an indication that the price is well underway. There's strong momentum. There's enough strength by the bulls. It's going to propel the price action to higher ground. You can, in a sense, make much more gains much quicker. Okay, so a narrowing histogram suggests that a crossover may be approaching, so a shifting trend, and a widening histogram suggests that it's an ongoing trend is likely to get even stronger. Okay, so also something else to remember is that the longer the price action, the longer the histogram is in positive territory, so 0, made a mess here, oh my God. The longer the histogram bars are above the 0 level, the more confidence you have that the trend is going to continue moving to higher ground. The longer and larger the histograms, the histograph bars are below the 0 line, the more confidence you have that the price action is going to fall to lower ground. Okay, so there's a prevalence of the trend depending of where the histograms are green or red, above 0 or below 0. Okay, so I think this is enough. We've done way past our times. I've been blabbering a lot today. I apologize, guys. So this brings us to the end of today's session. I can't remember exactly what we have coming up next week. I'm going to see the schedule, let you know. For the time being, thank you for being here. If you have any sort of questions, please send them through. I have an email, webinars@t4trade.com. Go ahead and email me there. I'll be more than happy to answer any sort of questions that you have. But enough is enough. Take care. Have a good, lovely weekend, guys. See you next week. Okay, take care. Bye bye.